What if I told you this entire market breakout is actually a carefully constructed trap? Smart money just positioned a massive negative 165,831 net short exposure right under your nose. Retail is buying this move, but if you leave this explainer now, you'll miss the real story. Negative 165,831. That is an absolutely massive net short exposure, guys. And no, that's definitely not a typo. That's the actual real-time position held by institutions right now. Behind closed doors, they're heavily shorting the E-mini S&P 500. They're aggressively stacking shorts, all while retail traders just keep buying indiscriminately. Listen, something massive and highly destructive is coming to this market. Understanding this exact positioning is absolutely crucial for your survival. We have to decode their true intentions before this trap springs shut. We've got to look at what smart money is really doing behind the scenes, because this massive disconnect creates incredible opportunities for those paying close attention. Right now, everyday retail traders are aggressively buying into this false breakout. They see those big green candles and man, that intense FOMO kicks right in. They blindly trust the upward momentum flashing on their screens. But institutional order flow is telling us a completely different and frankly dangerous story. Institutions are quietly heading for the exits as we speak. They're literally dumping massive positions right onto unsuspecting retail buyers. It's a classic textbook institutional distribution trap. See, smart money creates this false sense of security. They use all that retail buying pressure just to offload their own heavy bags. And when retail finally runs out of capital, the market just drops. You absolutely must recognize this disconnect to protect your own capital. The proof is right here in the CME COT report. This data reveals exactly what smart money is doing behind the retail chart. Institutions are secretly building a massive, impenetrable wall of shorts. They're actively positioning for a serious liquidity sweep. See, these guys don't guess where the market goes next. They engineer the exact conditions needed for a violent reversal. The data clearly shows they are heavily net short. And historically, this kind of positioning precedes massive market-shifting events. They are literally setting the retail crowd up for an absolute slaughter. We use this public data to track their exact footprints. Because let's be real, following the smart money flow is the only way to win.
Okay, let's translate this raw data into actual predatory market behavior. Non-commercial entities are aggressively adding to their short positions. These are your institutional whales driving the real market flow. Then you have the commercials. They're actively hedging their exposure right at the exact highs. They're protecting their downside risk right at the very top. Meanwhile, look at the non-reportables. They're buying the absolute peak of the rally. These non-reportables are your retail traders, totally trapped in FOMO. Smart money is essentially handing the heavy bag directly to retail. This behavior shows a crystal clear transfer of risk straight to the amateurs. Institutions are perfectly positioned for a rapid, downward price expansion. They're just waiting patiently for the trap to fully close.
This dynamic beautifully illustrates severe macro flow rotation in real time. Capital is moving rapidly, preparing for the coming shock. Look at the last month. Brent crude dropped almost 17%. The VIX volatility index completely collapsed, down over 23%. But meanwhile, sectors like tech and natural gas are suddenly surging higher. Guys, this is extreme late-stage risk-on behavior from desperate buyers. Capital is just hiding in very specific, overcrowded pockets of the market. A divergence this severe across asset classes signals major structural instability. The broader market internals are actually weakening, even while specific indices climb. This capital rotation connects perfectly to that heavy institutional shorting. They know the macro environment simply cannot support this artificial rally. We are witnessing textbook late-stage rally exhaustion. Make no mistake, this is not a healthy, sustainable market breakout. It is a deliberate, mathematically calculated topping process. The market structure is highly vulnerable and wildly overextended right now. A sudden, violent liquidity sweep to the downside is absolutely imminent. Institutions are getting ready to pull the rug completely out from under this. And when that reversal happens, it's going to be fast and merciless. Retail traders will be trapped in massive drawdown instantly. You have got to be prepared to trade alongside the smart money. Please do not become liquidity for institutional profit caking. We have to anticipate this crash way before the red candles actually appear. Now, when retail traders look at the weekly time frame, they see a perfectly safe uptrend. Prices holding beautifully above all those critical moving averages.
The RSI indicator is sitting comfortably around the 64 level. Honestly, the technical structure practically begs amateur traders to hit buy. They really believe this trend will just continue upward forever. But if you're only reading standard candles, you're only getting half the story. Standard indicators completely lag behind the real institutional order flow. Retail relies on these patterns that institutions intentionally create just to deceive them. This weekly structure is literally the bait in the institutional trap. It looks absolutely beautiful right before it completely falls apart. We have to look deeper to find the true narrative. So, zooming into the daily time frame reveals a completely different truth. Price just hit an all-time high of 75.7825. Out there, retail traders are cheering and heavily adding to their long positions. But look closer. MACD upward momentum is completely stalling out right now. The rally is running entirely out of necessary buying gas. We are seeing weakness forming precisely at these historical critical high levels. Guys, this is a massive red flag for any knowledgeable trader. The price keeps pushing higher, but the underlying momentum is just dying. This daily divergence totally confirms the institutional distribution taking place. Smart money is actively fading this exact daily high. They're just absorbing all that retail buying pressure right here at the top.
But the real hidden trap lies deep within the 4-hour time frame. We see this very steep, aggressive, and continuous uptrend. However, the trading volume is visibly decreasing as the price climbs higher. This severe volume divergence indicates an absolute lack of institutional buying. Professional money is simply not supporting these inflated prices anymore. And without institutional backing, this entire structure is completely hollow. A market climbing on low volume is extremely fragile. It literally only takes a tiny catalyst to break the floor. When institutions finally stop absorbing the buys, the price will collapse quickly. This low volume push is specifically designed to trigger retail stop-loss orders. It's a purely mechanical draw on liquidity right before the big drop. You know, retail traders always chase that 7,600 psychological resistance level. They mistakenly believe these big round numbers actually dictate market direction. But institutions do not care about artificial retail resistance zones. Instead, they target internal liquidity pools resting way below current prices. They are eyeing massive stop hunt zones sitting below the 7,500 level. Smart money is actively out there hunting for your protective stops. Your stop loss is literally their preferred entry and exit liquidity. They will engineer a sudden drop just to trigger those specific orders, because that is exactly how they acquire the liquidity they need to profit. We have to align our bias with their actual liquidity targets. Stop chasing psychological numbers like an amateur trader. Of course, institutions still need a strong trigger to launch this massive trap. And this week features ADP, ISM services, and Friday's non-farm payrolls. This blockbuster macroeconomic data is their chosen market catalyst. They're going to use this fundamental data to trigger the sweep. Listen, high-impact news is really just an excuse to reprice the asset. It provides the exact volatility they need to hunt resting liquidity. Retail traders will inevitably blame the news for the sudden market crash, but the institutional order flow was already positioned for it. The trap was set long before those numbers were ever released. Prepare yourself for some serious, violent volatility when these reports drop. We are ready for the exact move they're planning.
All right, so here is the official and actionable institutional trade setup. We are operating with a strict and definitive sell bias. Our entry zone is precisely between 75.90 and 7600. We're going to use this premium zone to hunt internal liquidity lower. Your hard stop loss must sit strictly at 7635. Target 1 is that highly liquid 7480 pool. Target 2 extends all the way down to 7150. This trade perfectly aligns macro weakness with actual institutional positioning. We are fading the retail breakout and selling the premium. This setup targets the exact liquidity pools that smart money wants. Execute this plan with cold, calculated institutional precision. Just remember, a daily close above 7635 completely invalidates this setup, meaning retail momentum has temporarily defeated the institutional flow. Retail traders blindly react to raw price movement. Institutions mathematically react to massive pools of available liquidity. They carefully lock profit, all while the crowd buys the breakout. Look, price moves toward liquidity, not toward your personal opinion. The market truly does not care what you think will happen. It only cares about where the deepest liquidity rests. You need to let this truth fundamentally change how you view the charts. Stop reacting to green candles and start tracking the flow. If you only read candles, you're only seeing half the story. Really remember this critical insight the next time you feel that FOMO kicking in.
Make sure to subscribe and leave a comment below. To follow future trading opportunities and detailed market breakdowns, you can open your trading account using the link in the pinned comment. We decode smart money flow so you can survive these market traps. Do not let institutions use you as their exit liquidity. Master the macro narrative and align yourself with the smart money, because when that institutional trap finally springs and the market drops, which side of the liquidity sweep will you be on?